You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith, Senior Analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Hi, Jim.
Gold and silver bears. Was last week your best shot?
I'm beginning to wonder about that. You know, there's a lot of evidence that indicates that we are forming a very substantial base in here, and it's, you know, the double bottom was put in the miners and the metals really last June, July period, and then tested again in December and tested again late this spring. And nothing's 100%, but I'll tell you, I'm very happy with what I see. I look at a lot of indicators that indicate, I would say, a preponderance of the evidence. Not beyond a reasonable doubt, but a preponderance. Things like the accumulation in ETFs, the fact that the miners on balance are stronger than the metals, the fact that the metals can survive pretty handily the big sell-off they had last week where gold dropped $30-some an ounce and silver was down about 50 cents. We're still well in that holding area that has a lot of support in layers below where we are now. And even if we had a spike down below all that, it wouldn't change my view because I don't think it would last. I think it would come right back up again. So we're heading in to the strong season for the metals. Reg Ogden's famous comment that July 25th tends to be a day when you really see, in retrospect, that it was a very strong defining moment for the miners in the summertime. And so here we are, you know, just a few days away from that. The imports to China and India, in terms of gold and silver respectively, are tending to move very strongly this year, as it was last year. We're still seeing near record sales of American silver eagles. And the world has become a powder keg with any number of things going on that could become an order of magnitude more serious overnight.
Is it still disappointing that India hasn't changed legislation that restricts gold imports?
It is in one sense, but again, just like what happened last year, the surge in silver went through the roof, and so silver imports into India are very, very strong this year. And also the illegal importation of gold into China is only going to get stronger because the demand is there, and it's going to be met one way or the other.
Illegal importation into India?
Yes.
Right. And what about China's, it seems, insatiable greed to accumulate gold?
Well, they got a big plan, and, you know, they could very well be the third largest central bank holders of gold on the planet. They haven't reported for quite a while, and they'll do it when it suits their needs to do so. But some people have looked and they've said, oh, the gold imports into Hong Kong are down. That means the Chinese aren't moving as much in. But they fail to realize that now this year, China is allowing gold to be imported directly to Beijing, not coming through Hong Kong only. And so this enables them to import quite a bit of gold that really goes under the radar. So we really don't know how much they're bringing in, but the odds are that it is still substantial, and it still could be setting records.
Is this to help their balance sheet? I just saw a report that said China's debt is 250 times its income right now.
There may be some for that, but this is part of a strategic plan that goes beyond the quarterly report of what's going on in the economy. And it certainly could help it, indirectly and directly, but their plan is much bigger than worrying about, you know, where the gross domestic product is going to be in the next quarter in terms of their reasoning and the rationale for importing gold. And I think what's even more important than either of these two issues in the intermediate term has to do with the continuing inroads that the Chinese are making with the yuan in terms of international finance. Just a few days ago, Switzerland announced that it was going to set up swap agreements with China where they would exchange currencies up to I think it's something like 25 billion a year, going out several years, and it would be renewable. And also, the Swiss are going to avail themselves of some of the debt vehicles that the Chinese have. So all of this is serving to dilute the effect of the U.S. dollar as the preeminent and only reserve currency and move it down the line here before too long, in my view, as first among equals, but no longer king of the mountain.
Is that going to affect how Canada does trade. We always take a look at how the Canadian dollar compares to the U.S. dollar. Should we be taking a look at how we compare to other currencies then in Asia?
I think so. It's going to affect everybody's currency and everybody's trading, and it wouldn't surprise me to see Canada announcing at some point this type of agreement in terms of swap agreements that the Swiss are doing and that other countries are doing as well too. And I think the BRICS are a force to be reckoned with in terms of their efforts to put together a parallel currency situation to the U.S. dollar, and it's going to have very large effect on our standard of living as time goes on, Canadians and Americans, and it's going to have a very profound effect on the price of gold and silver going down the line.
BRIC has decided to have its own development bank in competition with the World Bank. Is that a concern?
That's just one more element in the discussion that we're having today in that regard. You know, one of the things that I really like about what we're seeing in the metals market with this foundation that is being formed that is really getting solid. If you look at palladium, we've discussed that a lot over the last couple of years, and I guess 6 months ago or so, it was trading at $700 an ounce, and now it's almost $900. And if you would look at any given period of time of, say, several weeks when we were talking about it from time to time, it didn't seem to be too exciting or like it was going anywhere in a real straight-up manner. But what it was doing, it was building a very solid foundation. It would move up a little bit more, build another foundation, and keep on going. And now all of a sudden it's $200 higher, which is a pretty big profit to take place over that amount of time. And I think we're going to see the same thing with gold. A lot of people are still going to be kind of impatient, and they're going to think, oh, this is never going to happen. It's not going to go anywhere. And they'll wait until it gets up substantially higher before they buy something. But what we've seen over the last few months and what is probably going to go on for the next few months is still a really great opportunity to buy your favorites into weakness, and the same thing in terms of dollar cost averaging for the physical metals themselves. I think people that do that and do it, conscientiously and calmly will be richly rewarded over the next few years.
David, you said you had 2 honorable mentions you wanted to mention this week.
Jim, we generally don't mention specific stock names or ETF names on the show, but I think that this one is worthy of bringing to people's attention. They can look at it and they can compare it with some of the other ETFs that are out there. I'm sure doing the research on it. I don't own it right now, but I wouldn't be surprised if I do, reasonably soon. And that's Sprott's new Gold Miners ETF. The ticker symbol on that, on the NSEA ARCA, is SGDM. That's Sierra Gold Delta Mike. And it premiered July 15th, just last week. And it's got a little different approach, which I like, and I think it's going to be very interesting to see the market's reception to it in terms of the volume increase in trading quickly and where the price goes. And I think people will be very pleased with what it does. It tries to find the 25 top gold stocks that have the highest historical beta to the spot price of gold. And Sprott looks at each company's balance sheet on a quarterly basis to see, they want to see revenue growth. So they're picking not stocks that are high for whatever reason, but stocks that are high because they actually have something supporting them in terms of a growth profile underneath them. About 90% of the index are gold miners, around 10% are silver miners, and about 2/3 of the index itself is made up of Canadian miners, which very much closely approximates the global exploration dollars that are sent out to look for resources, which about 2/3 of the money that is spent, as you know, comes from Canadian exploration companies. And this will be competing, although I wouldn't say directly, against GDXJ, which is the Market Vector's junior gold miners. I think this is kind of in a class by itself and not directly competing with the junior gold miners index. But that's something that I think people might want to take a look at. The second honorable mention is a website that I've been reading a lot myself, and we posted on David Morgan's media sites, and that is a site called SRS ROCO Report, Sierra Romeo Sierra, and then ROCCO Report, and that's put out by Steve St. Angelo. And his work is really insightful on the precious metals. He has an eclectic view of what's going on. He posts other people who do articles from time to time, but most of it is his own writing. And he has a core focus on the role that energy plays in the harvesting of the precious metals. It's becoming more and more apparent that with the rising price of petroleum and with the extra waste rock that has to be taken out to get lower grades of gold, that's becoming a bigger and bigger factor in the cost for producing gold. And he has a recent post that really was intriguing to me. He looked at the gold grades of the top 5 gold miners over the last decade, and they're now having the lowest grades that they've had during that time. They're down to, I think, about an average of 1.2 grams per ton, I think is where it is now, which when you think about it, that's a lot of rock to move to get a gram of gold. And these companies are moving 50 to 100% more waste rock to get that gram of gold than they were 10 years ago. So I think this is a site that people would learn a lot from, and I'm over there quite frequently reading what Steve has to say, and I really highly recommend it to our listeners.
David, have a great weekend. I know it's a long way away, but we start looking at it, I think, on the West Coast. We start looking at the weekend on Tuesdays.
Well, that sounds good to me. I've been working hard all week writing for and with David Morgan on different things on our Morgan Report and getting ready for the next issue. And I'm going to be ready to, certainly by the end of next week, to really sit back a little bit and just take it easy. And I hope that our listeners will be doing the same.
Yes, we've been talking to Chris Marchese about the work going into this book. It's going to be a good read, but he said how to keep it under 300 pages, impossible. It'll be a bit more than that, won't it?
Well, we'll just have to see, but we're certainly going to do our best effort as a team effort to get things going. So you guys have a great time, and it's been super talking with you today, Jim. Thanks
again, David. My guest has been David Smith, Senior Analyst for the Morgan Report, which you can check out online at silver-investor.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.